Good morning, everyone, and welcome to the 25th episode of the Capital League Insight series of webinars. I'm delighted to share that we are entering our third year of conducting monthly webinars. It has been our privilege and pleasure in bringing to you a variety of domain experts since we first began the series in January of 2021. The topic for today's discussion is the year ahead. Now, the hallmark of the last 3 years associated with COVID, Russia's invasion of Ukraine, the resultant supply chain crisis, and other global developments and policy measures has been uncertainty. And someone has famously said, in troubled and uncertain times, we don't need greater command and control. We need better means to engage everyone's intelligence in solving challenges and crises as they arise. So looking around the world, and India in particular, government, RBI, and businesses have all been at their most agile ever in trying to manage the so-called polycrisis on several fronts. As a result, the Indian economy has been the fastest growing in the world, and Indian stock markets have been the best performing even in dollar terms in the last 3 years. So as we enter 2023, a slowdown in inflation, both globally and locally, looks imminent, with the global economy slowing and supply chains easing. And as China comes out of its nearly 3-year-long zero COVID policy, its focus on growth, led by pent-up demand, is expected to provide a counterbalance to global recessionary forces. So India seems to be better placed than the rest of the world, both from a cyclical and a structural perspective. But for equity markets, the litmus test, of course, will be the sustainability of earnings growth going forward. So to crystal gaze into the near and medium term future, to understand the confluence of multiple forces and factors, and for insights into navigating uncertainty, we have with us today Prashant Khemka, founder, White Oak Capital Management. White Oak was set up in 2017 and is one of the rising stars in the fund management industry. Prashant has a very rich experience both in the Indian and international markets, having spent nearly 25 years managing assets in the US, emerging markets, and India. In his previous role, he was the Chief Investment Officer and Portfolio Manager for both Global Emerging Markets Fund and India Strategy at Goldman Sachs. He and his fund have won several awards, and he's one of the topmost rated fund managers globally. Prashant, we are absolutely delighted to have you with us today. Welcome.
Thank you so much, Rajul. It's a pleasure to be here on the Capital League webinar. Thanks.
Our pleasure. So Prashant, before we deep dive into talking about the specifics, can you share your insights on the current global macroeconomic landscape?
I think, Rajul, you summarized it much better in 1 or 2 minutes than I could over the next half an hour or hour. But I think, as you pointed out, I would say that there are, over the last couple of years, these, first and foremost, the Russian invasion of Ukraine. Secondly, the treatment of COVID by China, the policies of China towards COVID,
Right.
COVID 0 and now COVID 100, if you will. Third, partly as a consequence of these two, but for a variety of other reasons, the inflationary environment globally, particularly in developed world more so than in India. So, and the resultant policy measures and the impact on asset classes. So if you look at these three, the COVID 0 policy is now being dismantled by China. In our view, that would lead to further normalization of supply chains, at least those segments of supply chains that were disrupted because of China and China's COVID 0 policy. So that obviously right now we are in the midst of hyper disruption because of the rampant rise in COVID cases in China, but that should smoothen out over the next couple of months. And then the supply chains which were disrupted for last nearly 3 years should fall back in place. And they impact because China is the supplier to the world, has been the largest supplier to the world. In every aspect of life, if you will, there were products and services that were used which were getting disrupted to some degree or the other over the last 2-3 years because of the COVID zero policy. So that, according to us, should be counter-inflationary or should support the declining inflation. There is a counter viewpoint that the increase in Chinese consumption because of opening up could be inflationary. However, yes, there are always counter acting forces, but we believe the disinflationary forces would be stronger. The forces that would act to reduce inflation would be stronger.
So actually, Prashant, to interrupt there, you are right. Even I think Goldman Sachs and a few of the hedge fund managers are predicting that price of crude will rally back to 100 per barrel in 2023 as China opens up. So do you think, I mean, that could swell the party?
Certain commodity, oil is anyways $80 right now or $83 right now. So 100 is not a big deal. And in any case, one has to take all these projections with more than a pinch of salt, maybe a bag of salt. Yeah. These projections get reworked and restated very quickly. Nobody has that crystal ball, nor do we. But $100 of oil price, at least for India, has not been a deal breaker. Obviously, every dollar lower is better than a dollar higher. And it's not something that the world has even grappled for the first time. We've had even as far back as 2006-07, we had $150 oil. So if at all that were to go there, that would not be a deal breaker. It would be a negative, but not a deal breaker. So China, I think, is a force. The reopening of China would be a positive force for subduing the inflationary pressures around the world. Already, the inflation has been on the decline, obviously still at fairly high levels in US as well as particularly in Europe. But for a variety of reasons, including the rebasing of the base, the inflation is on a decline. And people are now debating when during this year would Fed stop raising the rates, and it's within probably 50 to 75 basis points is the general expectation. So Russia-Ukraine then remains the wild card that is completely unpredictable, and we'll have to see as we go how that turns out. Even possibly Mr. Putin himself has not made up his mind on how he intends to take the course of the war forward. So no point in conjecturing there. If tomorrow or one fine day there is an announcement of some kind of a ceasefire, that would spur a massive rally around the world in all asset classes, because it would, amongst various positive implications, that would also mean a normalization of that element of the global supply chain as well, and further pressure on deflationary pressure, and market would then start factoring in quite significant declines in interest rates and whatnot, and market being a discounting mechanism would rally quite sharply the moment there is any sign of cessation of activities on the battlefront. On the other hand, if there is some kind of escalation further and it becomes nuclear, then that is on the other extreme, a negative. So that is completely, unpredictable as of now. But otherwise, the China phenomenon is positive, and that's how we would handicap the world, global economy.
Great. So, like you said, on the Fed, so right now there is a huge divergence between, what the Fed is saying it will do in terms of keeping rates higher for longer, maybe throughout 2023, whereas the financial markets do not think that Fed will do that. So going by what the markets think, do you agree that without further increase in interest rates beyond, let's say they're at 4.5, so beyond 5, the current level of rates and recessionary forces will push inflation all the way back down to Fed's target of 2%?
Certainly. So I'm a big believer in markets, much more so than any central bank. So I think markets also understand that you can't just go by what the central banks are saying, because the central
Mm.
banks themselves might not be saying what they believe to be the case. They have to portray a certain degree of discipline or hawkishness, if you will, so
They
as
have to keep the expectations in order.
to anchor the expectations. Otherwise, they risk diluting the impact of their actions. But I think markets are far better, historically, have proven to be far better at anticipating these things. So I will go with the market that the peak rates are nearby and that inflation is coming lower, and there is likely to be mild recession in the US, which would force the Fed's hand. And at some point, they'll start talking about they'll start talking the from the other side of
About reversal.
person, and that's what the markets are factoring in.
So Prashant, for last, few years, ever more so since COVID, there's been an inclination towards deglobalization and finding alternate chains of supply or even self-sufficiency where possible. So do you think that is going to stay? And if not, then are we talking about a more prolonged and fundamentally more tenacious inflationary environment in general? I mean, we will never go back to those 1-2% levels.
Certainly. So see, first of all, it is, in our view, not appropriate to attribute entirely the long-term subdued inflationary environment that the world has enjoyed over the last 4 decades to globalization. Number one, probably a far more powerful force has been technology, advances in technology, and what it has done to in terms of increasing supply of almost everything. This supercomputer used to be a room back 40 years ago, or air-conditioned room somewhere at the headquarters of IBM. And today we all carry this supercomputer in our pockets, and it is connected. Each one of us are connected through it with mobility. So there is a massive deflation in many regards in a lot of the services and products that we use over time. But deglobalization, see, globalization over decades has moved in the right direction, but it's never moved in unidirection and all. It's not that it's always moved forward. Sometimes it takes 4 steps forward, then a step backward as well. So maybe over the last couple of years, that was a step or 2 backwards. And now with normalization of the COVID related disruptions around the world, we can see that turn turn into a positive tailwind as well, as we were just talking a few minutes ago. Longer term, I think it very much remains with some puts and takes, a increasingly globalized, integrated global economic order.
Sure. So from an FIS perspective, how are they looking at China now? I mean, one is, of course, businesses, like you said, maybe things will come back to normal. But China has been known for its unpredictability and opaqueness, and their stock markets have been on fire in the last 2 months. So how are foreign investors and other stakeholders approaching the situation?
So as of today, foreign investors are quite upbeat on, let me say, not quite upbeat, but they want Chinese exposure, whether they are upbeat or not upbeat, because there is a lot of fear of missing out if the rally continues. And see, if the rally continues for another couple, 3 months, let's say Chinese market went from 100 to 50, so 50% downfall from the 21, and then it's bounced back 40%. So it's gone from 100 to 50,
70 now.
70. If this thing continues and has another 30-40% up move, people would find positive stories to justify that up move. So we are strongly of the opinion the stories are formulated to support the market moves, and the sentiment evolves in conjunction with the market moves. It's not the other way around, where stories or sentiment determine where the markets are headed. 2.5 years ago, which is about June 2020, the relative preference of investors for China versus India was never higher in my career. I had never seen people favoring China over India as much as they did in June 2020, when India was suffering through COVID chaos with the migrant crisis and whatnot, with
Right.
international media showing pictures,
Mm.
full-page pictures of miles and miles of migrant workers walking to till the
Back to
horizon.
their homes, yeah. Mm.
Whereas China seemed to be in complete control. They had, despite being the origin of COVID, they weren't having any cases. Yeah. And
Mm.
Wuhan was taken under control and China was reporting zero. So COVID cases. So investors were like, look, China is perfect example of how to control things. And even the worst of the adversities, whereas India is very chaotic. And there were several clients, long time India investors
Mm.
who took money out, completely exited India and switched that into China. And then just 2 years later, the mood was exact opposite. And all the stories were there to support it. Yeah. India is
Mm.
growing faster. China's, authoritarian, lack of democracy, all those valid reasons, but those reasons also existed back then.
Back then, yeah.
Democracies and authoritarian. It's not that people didn't know that Xi Jinping is going to run for a path-breaking, a president-breaking third term, and that
Mm.
he.
Mm.
So it's again the stories would follow. So right now, to your question, if Chinese market continues to do better, like in last 2 months, it's outperformed India market by 30 to 40%, then the preference would level out again, and people might start preferring. People might again say the same things again, that Chinese equities are also growing very fast and they're cheaper, and so on and so forth. And there could be more of a leveling of interest between India and China.
Mm. So we have seen FI outflows of nearly 2 lakh crores in the last 15 months since October of 2021. And despite that, I mean, we have been the best performing market for last 3 years because of the participation of retail investors coming to our rescue. But today, our valuations are more than double of other emerging markets and also a little higher than our own historical average. So I want to understand from you, I mean, both now and earlier, from an FI's perspective, what attracts them to India, what justifies our high valuations versus other emerging markets. And India's weight in the emerging market index has increased to about 14.5% now. So do you think FIs will come back this year, and will we get our fair share of inflows?
Certainly. Well, thank you, Raju. So there are multiple questions within that.
Yeah, multiple questions, but
so let me break it up. First of all, I'm not fully in agreement that the flows, whether it is domestic or foreign flows, drive the market levels. It is more vice versa. The market levels often drive the flows. Now, let me then address why.
That's interesting.
Yeah. Because everyone behaves like retail investor. It's no different. If the markets are at the bottom in March 2020, nobody was investing, neither retail nor foreign institutions. Always the flows are maximum at the peaks. But putting that aside for a minute, the FII outflows, it is paradoxical that on one hand, we talk about very strong interest from FIIs and global investors in India, and yet there were massive outflows last year.
Yes, yeah.
That has to be taken into context or seen in the context of the fact that out of the $700 odd billion that are invested in India, 70 to 80% of those holdings are held by multi-regional funds, like emerging markets fund managers, like global equity fund managers. So for example, the direct India equity is only 20 to 25%.
Okay.
So globally, last year, because of all the concerns of the Fed and everything that was happening, Russia, Ukraine, and everything that we spoke about, investors have not been that upbeat on equities in terms of inflows, because equity markets, US has been coming down, global markets have been coming down.
Yeah.
They've been withdrawing money. Yeah. So when they withdraw money from emerging markets, emerging market managers, like we ourselves also have an emerging market fund. If investors were to withdraw money from them, beyond the point, you don't have a choice of not impacting India. You have to sell Indian equities also, because otherwise
proportionately,
proportionately, exactly. So if India's weight is 15%, as you were saying earlier, it has doubled from about 7-8% 5 years ago. Then if there's $100 billion of outflow from emerging market funds, then 15 billion, approximately 15 billion of India would also get sold, even if the managers continue to like India. So that has been the biggest contributor to outflows during the last 12 months, much more so than India dedicated outflows. So that is the second point I wanted to make. And Rajul, did I cover every aspect of your question or did I miss out?
No, so then I wanted to ask you that in terms of valuations, what justifies them? Because we are quoting at twice the valuations of other emerging markets.
Certainly, certainly. So here I would request a slide to be brought up on the longer term historical valuations of India. India is, as you rightly pointed out, always traded at a premium, and rightly so, deservedly so. Worldwide, it is observed, and we've done a lot of work, analysis on this, that democratic countries tend to trade at a premium compared to less democratic countries. So India being the democracy tends to trade at a premium and has always traded a premium. As you'll see in the top right-hand side, if we do it full screen, you'll see on the top right-hand side, India's on average over the last 16 years traded at a 40+% premium, the dark dotted line.
Right.
It is true though, today the premium is at near 3 sigma. It had gone even higher, more than 3 sigma levels, but today it is trading at 2.5, 3 sigma levels higher than global valuations. The sharp jump over the last 6 to 9 months, or 6 to 18 months, I would say, is to do with the de-rating of China, much more so than re-rating of India. You'll see the top left-hand side slide, top left-hand side graph, which shows India's P multiple relative to its own self. So the very long-term average has been 17.2.
Right.
During the Modi regime, over the last 8 years, or nearly 9 years now, the multiple has been higher at 20.7. And so we are trading at, so let's say Modi era multiple at 20.4 right now, right in line with the last 9-year average. But you'll see the EM relative to EM, our multiple has expanded. That means EM's multiple has gone down, and that is primarily due to the de-rating of China.
Okay.
And over the last couple of months, the drop that you see in India's premium is because of the 40% move that China has seen. So if China were to do again, as it has done over the last 2-3 months, then India would continue to come back into its longer term range of 40 to 50% kind of premium to global EM.
Okay, so another part of the question was that, do you think FIs will come back this year in 2023, and will we get our share of the inflows? So, I mean, for that, of course, will they start investing in emerging markets again? China, of course, like you're saying, they're doing, but
Certainly.
Are they getting the flows in their funds?
Certainly. So we can remove this slide for now. So see, this is a unpredictable thing. It's just not something that can be predicted. It's like a coin flip. It cannot be predicted. What I would say is, last year, people were worried about falling markets. Yeah. And that's why they were shy of investing in global equities. When investors are worried about falling markets, they are even more worried about emerging markets. Yeah, because emerging markets are a little higher beta.
Yeah.
But so they were worried about equities in general. They were worried about emerging markets last year. Within that context, they were positive on India. But when the first and the second is negative, the third can only help you so much.
Right.
This year depends on how these three variables play out, whether globally, whether equities are in favor, whether EMs are in favor, and then whether within that context, how is India? So if you have all three aligned, like in 2003 to 2007, you saw the maximum inflows during that time. Yeah. If the worst scenario is all three were to be out of favor, last year that did not play out. At least India was in favor. If now year to date already, global equities are up low to mid single digits. EM is up high single digit. India has not moved much. So far, only 15 to 20 days of January, but so far it seems that global equities are are likely to draw some interest, because markets go up, investors do flocked into that asset class. So,
Mhm.
and EM would draw more interest, but within that context, people might view that India is relatively at a premium, as we just saw, and that could subdue the inflows, lead to subdued inflows during the year, unless there's a Indian market also does very well this year. So it will
Right.
be a function of how the market does, Raju.
Understood. So, Prashant, given your background and experience, it would be great if you could compare India to some of its emerging market peers, and what are our unique strengths and opportunities and challenges for us?
Certainly. So Rajul, I'll try and I've not done this before, but I'll try and do this now. Compare companies,
Mhm.
why one likes a certain company over others. So
Okay.
at White Oak, let's say, so we like to say we believe outsized returns are earned over time by investing in great companies at attractive valuations. And
Mhm.
valuations is defined in DCF basis, not PE multiples. So we don't look at
Okay.
PE multiples. We just discussed PE multiples for India and EM and all because that's just easy to use. But
Easy to
that's not
use.
how yeah, but that easy to use does not necessarily mean it's the right thing to look at. But let's say, what's a great company? What we consider as great company is one that has these attributes of superior returns on incremental capital. Now, if you look at for India compared to EM as an average, India
Mhm.
does tend to have higher ROE compared to
Okay.
the rest of EM, even after adjusting for inflation.
Mhm.
That is one attribute that we look for great company, right? And that applies to India as a whole as well.
Okay.
Second, we look for scalability in a company, meaning can a company grow multifold or manifold compared to its peer in the industry or corporate world on average over business cycles, which basically means can a company grow faster than other companies in the peer group. Now, that also holds true for Indian corporate sector as a whole to some degree, as Indian corporate earnings and corporate cash flows and corporate top line has historically grown slightly, and all these are, it's never going to be multiple percentage points, but even slightly higher growth, just like in equity market with individual companies, a slightly higher growth for companies can mean vastly higher multiple, right? That is second. And third point, so superior returns, scalability, and third is well managed company,
Mhm.
both in terms of execution and governance. Now, execution, one can argue there isn't much to differentiate around the world, but governance is very crucial. And in India, at a country level, having a democracy does leads to superior. It's like in fixed income, the rating of a bond by any company in India is capped by the rating of the sovereign. If the
Mhm.
sovereign is rated triple B, then be it Infosys or HDFC or any bank or any company cannot be rated in global markets higher.
External rating, yeah, will not be
So
higher than.
governance as a democracy ensures, democracy means separation of powers, the separation of powers between the judiciary and the executive.
Okay.
That gives that gives stronger contractual rights to investors, not only domestic investors, but global investors. Yeah? And whereas in authoritarian regime, you don't have those separation of powers. And that is why you can have some authoritarian diktats which can heavily impact the profitability of the companies and sectors as a whole and investor returns. So if I were to just give you one, example of what I've always heard from investors globally as a negative, and I used to turn it around as a positive,
Mhm.
because I do believe in that. So people would always say, "Oh, India's infrastructure is so poor because because of democracy, even
Mhm.
a small farmer can stop the construction of a large infrastructure project in India. Whereas in China, they built the Three Gorges Dam, which affected millions of people, and yet there was no delay." Right. So I would
Mhm.
always say, look, this is the strength for Indian markets. You should take a lot of confidence in it that if in India, even the rights of a small farmer are protected and the government has to follow due course to take away his piece of land, then it would be, imagine how difficult it would be for the government to take away your rights as investors in companies, because those are contractual obligations of those companies and the country, right? So this is to be taken as a very big positive, that the country respects property rights, and ultimately equity is nothing but the right to perpetual cash flows of the company. In a country where the right is not respected even today, then how can you have confidence in it being respected over time, in perpetuity? And that is the biggest strength, in my view, of Indian market. It's not that we are unique amongst emerging markets, but it's a combination of this good governance. And that's why you find in the equity markets, companies with stronger governance trade at a substantially higher premium than companies with poor governance. Even if companies with stronger governance is growing slower, still they would trade at a big premium, right? Whereas in case of India, the combination of better governance, greater, somewhat stronger growth, and somewhat slightly higher returns on equity, these three combined together, and first and foremost, the governance aspect I would highlight, these combined together lead to a deservedly much higher multiple. It doesn't mean overvaluation. It's deservedly so, because even if it were a country with these characteristics, company with these characteristics, one would pay a much higher multiple for that.
So then one can say that from a medium to longer term perspective, it makes those valuations more sustainable and less at risk, because they are more fundamental and structural in nature.
Yes, true. Unless there are any changes in the structural.
To that, yes.
Yeah, but otherwise, and the changes could be, either way. I mean, some of the foreign countries,
they could get better.
Eventually, China, that was the expectation, that eventually China would move towards a democracy like Taiwan, Korea, Singapore, and all have done. The reason for de-rating in China has been because that's taken a bit of a setback. That belief that in China is moving. There was a single party democracy in China. Over the last 3 decades, there have been changes in the president, and very smooth changes. And that's, that's democracy, at least single party democracy, right? And now the setback is because there's some concern that there is no longer even single party democracy. And that's why the de-rating. But if that changes again to positive, not easy, but if that were to change back to a single party democracy, you would see re-rating over, next several years, though there's no sign of it. I'm just saying that those possibilities are there.
Yeah. One has to look at the possibilities, of course, I mean, at all times, especially in our work.
And the returns from the market, very crucial. The returns from the market are a function of change in these things, not a function of the status quo today. Because all these are already factored into the market valuations. So if there's a change towards further positive or change towards negative, that may impact the valuations.
Yeah, the delta is more significant.
Absolutely. The delta is really the flow.
Very important, yeah. So, Prashant, you have studied global economics so closely, both in the developed and the emerging ones. So what are some of the trends you see playing out in India and their likely trajectory, given how they have played elsewhere in the world? And in some instances, like India leapfrogging in technology, maybe there is no significant precedence there. So what is your sense? How do you see the whole thing playing out?
Certainly, I think, see, globally, when looking at you, so when I was, if I were to just digress a little bit, when I was a kid in school, I used to always be very optimistic and think India would catch up with the US in the next 10 years in terms of per capita and all that. That was when I was really young. Yeah? And then as obviously I grew older and older and learned more about the world order, I realized that it's, somewhat wishful thinking. So let me first tell you the pros and what is the negative, what's working for India. See, as we were talking about, the change is what matters. The delta is what matters. So pre-1990s, if you will, pre the liberation of policy, I mean, the liberalization, sorry, in the early 90s.
1991, yeah.
91, yeah. We were like a licensed Raj and extremely difficult to get anything done. Even now it is very difficult to get, but that was a different order of magnitude of getting things done. We were probably, I don't know, but if that time such rankings existed, we would be 175th or something in terms of ease of doing business. Out of 200 odd countries, we'll be pretty much the bottom decile. 8 years ago, we had climbed up to 142nd please. Yeah. So there was an change towards the positive, and ease of doing business means, in effect, speed of doing business. If it's difficult to do business, then it takes a lot longer to get
Right.
anything done. With increasing ease of doing business, you can do it in less time. And growth, the denominator of growth equation is time, right? So if it takes more time to get the same thing done, that is slower growth. If you can do the same thing in less time, it would lead to faster growth. And that is what has been working for India since over the last 3 decades, that the ease of doing business gradually, ever so slowly, has been improving compared to the earlier past. Yeah. Still, we are 63rd or 62nd or something in ease of doing business. Let's say we are 63rd. That means there's 62 other countries that are ahead of us in what I believe is the single most crucial metric. Because this one metric collapses a lot of other aspects of the economy into it, yeah, which leads to then.
Right.
So we are still 62 countries behind. In a game of cricket, we cannot tolerate being second to anyone. Yeah. But
Yeah.
in ease of doing business, I don't understand why we tolerate being 63rd. We have to, and obviously, over the last 8 years, we've come from 142nd to 63rd or so, but we still have a very long way to go. And that is a key difference between what I found in my travel around the world, be it when I was managing US funds based out of US, or as emerging market fund manager when I travel around dozens of different emerging market countries. A country's stage of development and per capita income and standard of living is very, very closely linked to ease of doing business. Developed world countries like Singapore, US, many of the European countries make it conducive for businesses to conduct business, and hence people start businesses, hire people, and leads to increasing level of economic activity. Whereas several countries, and India is not alone, Brazil is a quagmire of, all the things,
Regulation, red tape.
and the wrong kind of red tape and all that. I don't know where Brazil stands on the ease of doing business. I won't be surprised if it is worse than India, but I won't be surprised if it's better than India either, but it's probably certainly not in the top 20, 30. So this is something that I think there's a long, long way to go. We've come a long way, but there is a long way to go for India, and we can be optimistic about it, because if we continue to keep going on that path, then that would fuel faster growth for India for a long time to come. At the same time, we can even be, impatient about it. That I think there's reason to be impatient about it as well, because we're starting from such a low level that why can't we get more done? Why can't we go from 62nd to 20th and then to 10th in a rush? And that would that can fuel double-digit growth in India, which is what is really needed for us to, achieve, let's say, $10,000 of
Per capita.
per capita income over the next 3 decades. If we were to achieve that,
And get everybody out of poverty. I mean, not everybody, but the significant population.
Every percentage point of growth over time, as we know, the magic of compounding can, lift that many more hundreds of millions of people out of poverty over the next couple of decades.
So to your mind, are there any low-hanging fruits there which can be harvested?
Let's not get started on that one.
Okay.
Otherwise, you might have to edit a lot of it out.
Okay. So, okay, let's come back to markets then. So which sectors and themes you think will likely do well in the current year, 2023?
Certainly. So see, again, this is in the realm of impossible to predict. It is not very difficult to predict. I think people who say it's very difficult to predict, there are people who generally make a very articulate story and tell you which sector or market, small cap or mid cap or large cap or banking sector or auto sector or IT sector would do better. I think they, in our view, uh, they might be naive in believing it if they indeed believe it. Yeah. Secondly, there are people who just say it's very difficult to predict, but very difficult to predict is something that can be done, but it's just very difficult. We believe it is not possible to predict such things in the market. It is like coin flips. You cannot predict coin flips. You can do a PhD from MIT or Stanford in flipping coins, and they do have PhD for everything. And yet you would be no better than the layperson on the next coin flip. And it is in that zone. We do, as a team, tend to have higher exposure to certain sectors than others. They are more structural in nature, and they're more a function of where we find very high alpha potential in that sector. It's not our view that the sector as a whole would outperform other sectors, but we find individual companies that can generate a lot of alpha, and those sectors tend to be, sectors where we find companies with those attributes of superior return, scalable, and well managed. In our portfolios over long periods of time, they tend to be private sector financials, so private sector banks and other non-banking companies, as well as consumer discretionary. So consumer discretionary would, amongst various segments of the market, include retail, automobiles, so on and so forth, and also healthcare and IT services. These segments, at least as a combination, these four segments tend to always be substantially allocated in our portfolio, as against, say, energy, utilities, and commodities, which, though have had a fairly good run over the last couple of years, those we tend to struggle to find great opportunities to invest in.
So I also had a question there that, like we said, these high quality, high growth stocks in some of the sectors you named, they have suffered in terms of stock market performance all over the world, actually, in the last 1 year. And value stocks, more like your commodities, utilities, have found, even PSU banks, they have found favor with investors as higher interest rates kept denting valuations of expensive stocks. So do you see a reversal in 2023? I mean, I know longer term we are bullish on those stocks, or is it likely to take longer?
Again, Rajul, I'm sorry to be repetitive here, but this is again in the realm of impossible to predict. Yeah, over long periods of time, it has never been our view that these XYZ sectors, let's say consumer discretionary, private banks, and healthcare and IT services that I talked about, it's never our view that these sectors, either individually or in combination, would outperform the other sectors that I talked about, say PSU banks and the PSUs in general, and utilities and energy. It's not our view that one group of sectors would outperform the other group of sectors. It's impossible to say that, and very naive to make those projections, in my view. But it's just that the opportunity. So the best logical assumption to have ex ante is that all these sectors over time would perform more or less in line. Even if they don't do, there is no way. It's like if you flip a coin 10 times, the most logical expectation to have is 5 heads and 5 tails. Even though you're very likely, there's considerable likelihood that you'll get 6 heads and 4 tails, or 7 tails and 3 heads, and so on and so forth. But the best ex ante assumption that we go in with is these sectors would perform in line going forward, regardless of how they performed over the trailing 1 month, 1 year, or a decade. Yeah. Now, the reason to invest in a certain set of sectors to a greater degree than the other set of sectors, it's not that we don't have any investment in this other set of sectors. It's just that those investments are far smaller in comparison to the other sectors I mentioned. And the reason is simply the opportunity set. If, let's say, hypothetically, in one set, we find that all the companies are fairly valued in one sector, or more or less fairly valued for whatever reason. Maybe some of the sectors have 3 or 4 companies, and if they seem 3 or 4 companies seem all fairly valued, then there's no point in investing fairly valued companies. If, on the other hand, a sector like consumer discretionary has hundreds of companies, So it's possible, the potential that there will be very vastly misvalued companies would exist in such sectors to a much greater extent than a sector that is only 3 or 4 or a handful of companies. Similarly, a sector where which is plagued, let's name a sector, because companies within the managements within real estate sector would agree that our sector is full of crooks. Yeah, so we can name real estate as a sector. We do own some real estate because there are exceptions to the rule there as well. But if there are sectors where most of the companies have poor governance, then we would tend to stay out of that sector, even though from year to year, once in a while, they would perform, that sector might perform very well, but that is unpredictable, impossible to predict when that sector would do well. But staying out of that sector would help us redeploy that capital in other sector where we can find well-managed companies from governance perspective and generate higher alpha over time. Though year to year, the return might be same over extended period of time in terms of market return, but alpha being higher, total return can be higher in those sectors for our portfolio.
How do you ensure to pick, I mean, what all do you look at when you are picking companies which would generate a higher alpha for you? What are some of the important things you would look out for?
So alpha potential, as I was referring to earlier, when comparing the countries. So we believe outsized returns, meaning high alpha, is generated over time by investing in great companies at attractive valuation. So what we consider is great companies, one that has superior returns on incremental capital. So like even if a business is not listed, it's very commonsensical to, and everyone can agree, companies with higher returns on additional capital that is deployed are better than businesses with lower returns, all else equal. So superior returns on incremental capital, importantly, incremental capital, not just past capital. Yeah. Second is scalability, all else equal. Growth is better. Faster growth is better than slower growth, because that leads to cash flow growth. Yeah, if we can make this full screen, please. And third, when you have potential for first and second, you want a well-managed company in terms of strong execution DNA, such that the execution to deliver the first and second is sustained over a very long period of time, and it's not just short term. And third, and also very crucially, and maybe the starting point, it is a starting point for our investment analysis, strong governance. Because if all the other attributes are present, but governance is not there, then it may be a great business, but only for controlling shareholder, not for us minority shareholders, as value or cash flow would get diverted away for the benefit of controlling shareholder. So in such cases, you're better off avoiding that business if governance is not there. And governance is very crucially, as I said, the starting point for us. And when you find companies with all these attributes, it is very important to buy them at a valuation which leaves substantial upside to fair value. Because if you were to buy it overvalued, then you might have bought a great company, but paid such a valuation that you cannot make alpha from that investment. And that is where, so we are not from the school of thought. There is a school of thought in the marketplace that if you find great companies, buy them at any price and you'll do fine. Maybe that is fine to generate market return or just above market return, can be generated through that approach. But if your goal is to generate substantially high alpha, then valuation becomes very crucial to pay attention to. And that is what we believe that we are rightly focused on. We don't use PE multiple or EBITDA multiples at all, because they are distorted. We use, not to go into because it's not the right time to go into the details, but we use our own proprietary OpCo-Finco framework, which is an enhanced or adapted version of DCF in assessing value. And where we see upside and these attributes is where the team invests for high alpha generation.
So based on the model which you use,
sorry, Rajul, I cannot hear you. Suddenly for some reason.
Can you hear me now?
Yes, I can hear you now.
Okay, I was saying that given the model you use, the discounted cash flow model, today, are you seeing opportunities to invest? I mean, is it reasonably valued basis that model? Stocks are reasonably valued? Are they still expensive?
Sure. So Rajul, our framework is a relative valuation framework. One of the things, and again, we're taking a bit of it's a very important subject on which we can go on for long, but succinctly, if I were to put, we believe there's no such thing as absolute value. All values are relative. You are based in Delhi, Rajul, right? So
Yes.
there is a certain price per square feet in Connaught Place. There's a certain price per square feet in Noida. There's a certain price per square feet in, I don't know, Ghaziabad, if that is one of
Gurgaon, yeah,
Gurgaon.
Gurgaon.
So
But,
these
yeah.
are all, there is a relative, these are all relative valuations. Otherwise, a square foot is a square foot. And
Right.
the basis of premium at a certain place only makes sense relative to some other place, right?
Right.
And they tend to move up over time or down, usually not down in case of real estate, but up in relative to in some relative context. So similarly, all valuations are relative. First and foremost. Second, our belief is market is always fairly valued. I know it sounds a little counter to what people often might hear from other macro gurus, but market is always fairly valued. But within a fairly valued market, you'll always have overvalued and undervalued stocks. And if we can identify the relatively undervalued investment opportunities, then we can beat the market over any reasonable period of time. And as history has suggested in most countries, over any reasonable period of time, market tends to go up and give returns commensurate with the nominal GDP growth of the country plus the dividend yield, which
Right.
has been about low double digits in India for the last 2-3 decades and expected to be around 10% going forward. So if we can beat the market in the framework that we denoted, and the market delivers 10-11%, call it, then we can obviously do better than that, so that we don't worry about whether market's overvalued or undervalued, because it's impossible to predict.
Sure. So what would be your advice to long-term investors in these uncertain times?
So first and foremost, over the last 20 years, or almost over any time frame, when you are in the moment, it always seems very uncertain.
True.
So 3 years ago this time, or let's say in March of 2020, it was more uncertain than any other time in our lifetime, right? It was much worse than Russia-Ukraine war, because Russia-Ukraine war, we are not worried about our lives. In COVID, when COVID hit, we were all worried about our lives. Forget the equity market if we don't survive. And many companies were expected to not survive. That was a degree of uncertainty that was so humongous that current degree of uncertainty is nothing compared to that.
True.
Just put yourself for a moment in that mind frame of 3 years ago. Current uncertainty is nothing compared to that. And what is the biggest lesson from the COVID phenomenon? If we can pull up that slide, because that's very important to the question you asked, Raju. The key lesson of the COVID year is that the futility of trying to predict the market based on macroeconomic events or worries. Yeah. So the usual, if we were to break it down into 3 sub lessons from the COVID year, the usual perennial macroeconomic worries and anxieties of the well-known unknown variety are a colossal waste of time, meaning whether GDP growth would be a percentage point higher or lower, inflation would be a couple points higher or lower. Remember, in January 2020, exactly 3 years ago, people were worried whether GDP would accelerate from 5% the prior year, or could decelerate, or would stay flattish at 5% growth. And there were all those articulate stories about how there's no fiscal room with the government, there's no monetary policy room with the RBI, and so on and so forth. And people were worried, what if growth goes to 4%? Growth went to minus 7.5% that year, GDP.
Right.
And still, the market delivered one of the best returns in history. If you had told people only this one item, that for combination reasons our growth would be minus 7.5, they'll all sell out from the market and miss one of the best years. So it's a waste of, according to us, they hardly influence future returns of equity markets, if any at all, these macro worries of the well-known unknown variety. Lesson 2, nobody has a crystal ball to forecast cataclysmic risk events of the unknown variety, like the
Right.
pandemic. But more importantly, even if you were bestowed with perfect knowledge of what is going to happen with the pandemic, you would not know the market implication of it. In fact, you were and I was and everyone was better off not knowing the perfect to not be bestowed with a crystal ball, because if we were given a crystal ball, we would all have sold out. If we were
True.
given a crystal ball that only showed the economic reality and did not show what happened to the market, but only showed that a billion people would contract COVID in India and millions would die, and worldwide we'll still be 3 years later talking about COVID, we would all have cashed out. But fortunately, we didn't know, and we got the returns that we got. So finally, most importantly, to distill all these in lesson 3, investment decisions that are bereft of bottom-up analysis and instead driven by macroeconomic considerations are fraught with very high risk of absolute and relative losses, which is what happened to people who sold out in March 2020. Several people cut down their equity exposure. I know people in friends and family who were long-time investors, but either substantially cut or completely exited. And they could not step back in until the market was 50 to 100% higher, because they always complained about the dichotomy between the real world, where people are down and
absolutely right.
sluggish, and the market's rallying. They said market's gone nuts. It's because of the Fed, it's because of printing money and all the excuses to justify their action of exiting the market or cutting down on the market. And so our view is the markets, if we go to the slide on guaranteed real returns, over time, there's no asset class. And I have personally followed this myself over the last 30. I started dabbling into equity markets in the 1985 boom of Rajiv Gandhi for my family, on behalf of my family, because I got fascinated with this money-making machine, if you will. Since 1985, 1 crore of rupees then, and I've seen this personally amongst friends and family. I wasn't rich, but my friends and neighbors were rich. So 1 crore invested in fixed income today would be, so fixed deposit of SBI post-tax would be only 9 crores. 9 crores value today is much less than the 1 crore value back then, as you would agree, Raju. Inflation itself has become 1 crore has gone to 14 crore. So in real terms, fixed deposit has been a loss of value.
Value destroyer, yeah.
And that's universally true. It's almost an unwritten law of investment that risk-free return over time cannot earn inflation. Gold has been 27, but equities, the Sensex has gone 1 crore, has become 176 crores, which has really lifted the the standard of living of individual who would have invested in equity. And someone who can, because the return over this time has been 15% for equities, Sensex, compared to 6% for SBI fixed deposit and 7% for inflation. And someone who could have beaten the index by 10 percentage points. Easier said than done, but many people, several people have done that. Not many, but several people have done that. From 1985 to today, 1 crore would have gone to 4,264 crores. So I want to stress that every percentage point is very important. One would not normally think that 15% makes 1 crore into 176 and 25% makes 1 crore into 4,264. One would say, okay, 15 cut 25, so maybe instead of 175, you'll have 350 or 400. That's not true. Every point has exponential impact on the returns over a long period of time. And hence my view, I don't know how you framed your question, advice for long-term investors is to stop trying. The biggest destroyer of wealth is trying to time the market. So those who try to time the market make worse return than SBI fixed deposit, because they miss out on massive jumps. Yeah. So if you are,
which are unpredictable, as we discussed.
So if you are the sort of person who tries to time, then you're better off in fixed income. But for everyone else who can stay through, I believe, just not worrying about the macro and staying through, whatever is the asset allocation that you decide with your financial advisor, stick to that asset allocation. Otherwise, we'll be prone to making the wrong decision at the wrong time.
No, I think that's a very sound piece of advice, which we keep reiterating all the time. But one more time, it's never enough, because we see people, our relatives, friends making these mistakes all the time.
Yes. This is a
So-
single biggest lesson. When people ask me, this is my single biggest lesson. Fortunately, one that I learned with the help of my grandpa very early in my investment journey in the 80s. And I've only seen it reinforced almost every year.
True. True. Oh, that's wonderful, Prashant. I just have one last question. So not talking about predictions just for this year, but a general one, that when global economy attains a state of equilibrium, what, according to you, will be 2-3 things which would be completely different from pre-COVID times?
Equilibrium is certainly
Hopefully,
very,
we may touch it this
very
year.
difficult to imagine term, but I would say, and it's not necessarily very different, because we have one thing that has been most remarkable and amazing during our generation is just the advances in technology. Where we all grew, at least I grew up, where I had to take if there was a phone call ever, I had to go, my neighbor had to, we didn't have phone when I was in school, early years of school. So if there was any call, my neighbor would call us to their house because we had a call. Now all of us have a phone in our pocket. We are connected to internet, which didn't exist back then. And all these advances have been accelerated due to COVID. Yes, last year was beaten down, NASDAQ got beat down, and so this kind of statement seems out of place. But technology, like how we are interacting right now, Zoom was non-existent. I mean, video calls were hit or miss. Half the time it worked. There would always be a test call, a prep call before a video call, if you remember, because half the time it won't work. Right now we take, Zoom, Teams, all these video calls for granted. At spur of we organize. So it has had a profound impact. The technology advances made during COVID has already had a profound impact on the way we do things. And day-to-day lives as well, it has had profound impact, because in research, scientific research, is that it has a profound impact, right? When researchers can communicate like this, it helps research. So once research and science gets positively impacted, it impacts every sphere of life, be it medicine, be it economy, industry, corporate, and so on and so forth. And I think it would not be like a revolutionary thing that one fine day will realize all this has changed, but the evolution has been accelerated.
So Prashant, I mean, let's say you can invest anywhere in the world. So what would be your allocation to India?
See, certainly, I think there's certainly merit to diversification. In younger years, I used to be 100% invested in India. When I was working in the US, while I was managing client money for in US, my personal money was 100% in India. And the reason is not because I believed never did I ever believe that Indian market would deliver higher return than US market. And I think over the last 22 years, US has delivered 5% return, India has delivered 6% return, barely any difference. But the opportunity for alpha is higher in India because of more inefficient market. So diversification is desirable, but alpha is higher in India. So what I have done personally is invest in emerging markets beyond India. So as I was saying earlier, we have an emerging market strategy of our own. I'm also familiar with them. The reason is because other emerging markets are also inefficient. They are under research compared to developed world. So personally right now, my liquid net worth is roughly 50% plus in emerging markets and just shy of 50% in India.
Okay. Thanks for sharing that. I mean, I just thought, let me ask you that, because some of the clients did diversify over the last 2 years into international markets. And obviously that picture is not pretty right now. So one should hold on. Mean reversion should happen.
And these things have to be viewed from a multi-decade time frame.
Yeah.
Not on a year or two time frame. Just by the way, I have zero in debt. That also I would add. Everything is in equity.
Same here.
Yes. So 1 or 2 years, it can even be seen as an opportunity. If international markets have underperformed, it can be seen. I mean, people are not fully allocated. Nobody has as much diversification as would be appropriate. So if you keep adding every year,
Sure.
in a way, it's like an SIP into international markets. And over time, you'll get the average return, and the market return would not be much different from Indian market return.
Great. So Prashant, we would have to end the session now. Thanks a lot for this very, very enlightening session of yours. It is
Very
said
much
that
enjoyed, Raju. Very much enjoyed the engaging discussion and your very well prepared questions. Very much enjoyed.
Thank you so much. It is said that when nothing is sure, then everything is possible. And at Capital League, we believe in the power of infinite possibilities. So on this positive note, I would like to end today's session. And, saying it was wonderful to interact with you, and we hope to get you more often. And I'm sure the audience enjoyed the session as well. So, and thanks for your time, everybody, on a Saturday morning, and request you to please fill out the feedback form as you exit the webinar. Thanks, Prashant.
Thank you again, Rajul. Thank you, Capital League, and thank you everyone who's been listening. Thank you.
Thank you, and a happy and prosperous 2023 to all of you. Bye.
Bye-bye.